What's going on, guys? In this video, I'm going to share with you 7 trading psychology and discipline tips on how to deal with losses. All right, so first, roll the intro and then we'll get right into it. It's impossible to trade or invest and not find yourself into a losing position. That's just the way things are. And a large trading loss can be devastating, not only financially but emotionally. As defeating as losses feel, how you react to a big loss is more important than the loss itself. Inexperienced traders suffering a large loss can become hijacked by their emotions. Some may try to trade through the pain, often creating more turmoil for themselves. Some may withdraw from the market to avoid thinking about it. Others may try to trade in revenge, determined to recover their losses. None of these reactions are constructive. In fact, they can be destructive if you don't learn how to handle losing trades. Whether it's an obvious minus in your strategy, a lack of discipline, or any other reason, nearly every trader will face a big loss or several in their career. After a losing streak or a big loss, you may begin to question yourself, which leads to the typical problems many new traders have, like getting out of trades too quickly, holding on to them too long, skipping trades with the fear of losing, or getting into more trades than you should in an attempt to get some winning trades. One major difference between successful traders and failed ones is how they handle trading losses. Successful traders treat losses as an opportunity to learn and improve their trading. Coming back from a large loss is challenging, but success is never accomplished by ignoring losing trades. Losses, especially substantial ones, can be opportunities to become a more skillful trader. So here's 7 rules successful traders take after a loss to become emotionally stronger and more disciplined. Number 1, never let a bad day cost you more than you make on an average win day. Knowing how to lose properly is a must in a long and prosperous trading career. If you average, let's say, $200 on your winning days, you don't want to lose much more than that on a bad day. Control the downside. Knowing how to minimize your risk is the most important aspect of trading. There are really only 4 possible outcomes to a trade or investment: a big win, a small loss, or a big loss. As long as we eliminate the big loss from our trading days, we can live comfortable with the other 3. In my opinion. Risk management is the primary cause for a successful or unsuccessful trading experience. A sound risk management strategy can yield a steady increase in profits, while a poor risk management can wipe out an account in a very short period of time. If you follow the 1% risk per trade rule and a precise stop loss level, you'd know beforehand the amount of risk losing should your trade turn negatively. All right. And this goes hand in hand with the second rule. Number 2, know the stop loss level before you enter into the trade. The stop loss is a simple tool, yet so many traders and investors fail to use it. Whether to prevent excessive losses or to lock in profits, nearly all trading styles can benefit from this. Think of a stop loss as an insurance policy. You hope to never use it, but it's good to know you have the protection should you need it. So always use a stop loss and know its location before you get into the trade. Also, never widen your stop losses when the market moves in a negative way. Know that regardless of what happens, there's another trade around the corner. If your trading strategy relies on the success of one single trade, it's a bad trading strategy. Remember, trading success is the accumulation of many successful managed both winning trades and losing trades. Now, number 3, don't get involved in revenge trading. A big loss causes all sorts of inner conflict, a need for leverage, fear, anger, frustration, self-hate, market hate, and the list goes on. After a big loss, there's no way to trade with a clear head. There are more than 250 trading days in a year, so there's no rush to get back in there. If you're trading crypto, it's 365, 24/7. If you do so, you're basically revenge trading. Rather than looking to your strategy and make sensible decisions around the incident, you jump straight back into the market. This is dangerous for your account for 2 main reasons. First, it forces you to throw your trading discipline out the window. It shifts your focus from your trading process to trying to make enough money to recover your losses. Trading based on emotions and luck is not trading, it's gambling. It's also a lose-lose situation. If you lose a revenge trade, you increase your losses even more with a trade that you had barely planned for. If you win, then you just believe that trading on guts and emotion works, and you're going to do it again. So don't do it. So number 4, accept responsibility if you've suffered a large loss. Be sure to own it. Don't brush it aside, hide from it, or blame the smart money or whatever for your loss. There's always an excuse for losing a trade. But as traders and investors, we must accept the risks. Until we accept that we are responsible for whatever happens with our orders, the same thing will happen again. Accept responsibility and figure out what could have been done differently. This will help reduce the chance of it occurring again. It's also healthier than blaming other factors for your mistakes. Blaming others is admitting you don't control your own trading. And if that's the case, you shouldn't be trading at all. If you control your trading and investing, then you can fix it. And there's always something that can be done. It may involve changing markets, changing your strategy, changing your style. If you find that scalping the 1 minute brings you a lot of losses, try swing trading. The solution is there, you just need to find it. Which brings us to number 5. Stop trading for a while sometimes. It's better to take a break and figure out what went wrong. Do these things so you can get back to a better mindset in which you can refocus. After that, assess what happened by reviewing events carefully. Think about where you fell short. For example, did you take too much risk? Was the trade well planned? Were you mentally sharp, or did you hold a losing trade hoping to avoid a loss? Taking a break from trading is one of the hardest things to do, but it's a smart move. Wait for the conditions to improve. Preserve your cash, save your sanity, and focus on things. When the conditions improve, so will your results. Remember, the market will not disappear tomorrow. Nothing terrible will happen. On the contrary, during this time, away from the charts, you will likely come up with new, better ideas on how to improve your trading. Number 6, trade lower position sizes after a big loss. Confidence can be low. Not having a clear mind can cause you to skip trades, panic out of trades, or be overly aggressive. None of these are good. Take a step back and trade in a demo account for a few days, for example, because it's not real money and there's less pressure in a demo account. So it's easier to focus on trading and not worry about the financial aspect of it. A few winning days in a demo account will raise your confidence levels and put you in a better mental space to take on the markets again with real money. So after a losing streak, start small. Don't jump right back into the same position sizes you were using before. In the first days back, trade small position sizes. A winning day with a small position size will help build your confidence, and you'll slightly increase your position size as the account balance goes back up. If you have a losing day, losing on a small position size is easier to handle than another losing day on a full position size where you take a big loss. Even if you win a few days in a row, increase your position size incrementally, so it takes a little while to get back to your full position size. I know after you've tried bigger position sizes, it's annoying to start back with smaller position sizes, but it's for the best. Bouncing back from a losing streak is about getting back to the basics and implementing a strategy well, not actually about making money. Money comes from implementing a strategy well. Demo trading and trading small position sizes gets you refocused on what's important so you can start building your confidence again. Number 7, let go of the outcome and embrace the process. Realize that trading is a continuous process of learning. Most of the time in trades, like in real life, you learn more from your mistakes than from your victories. Losing money should motivate you to look closer at your actions, read more, better educate yourself, become more disciplined in your execution, and so on. Next time, you'll have a better idea of what happened and where you went wrong. This can open up room for improvement and start stacking the odds in your favor. As cliche as it sounds, putting your focus out of making money and into enjoying the process will help keep you on the right track and more likely end up in profit. So if you've learned something new and you found the value, leave a like, show some support, subscribe to the channel, and hit that bell icon so you can stay in touch with new uploads. Until next time, have a great day. I'll see you on the next video.